In this video, I want to talk about something most traders completely overlook: market condition. Not entries, not indicators, condition. Every market at any given time is in either a strong position or a weak position. And once you identify that, your job becomes simple. Strong market, I'm only looking for long trades. Weak market, I'm only looking for short trades. Anything else is fighting market intent. And when you stop fighting the market and start trading with it, everything changes. Earlier this week, a trader reached out to me and said he had an indicator he liked, but it was inconsistent. Some days it worked, some days it didn't, and he wanted to know if I could help him understand why. We set up a Zoom call and he walked me through the indicator. It was fairly simple, looked like a set of moving averages. It gave a long or short entry, an entry price, and a fixed target, which was a yellow line about 10 points away from the entry. He then showed me a day where he followed the signals exactly and still ended the day with losses. What stood out to me immediately was the market condition at that time. At those prices, NQ was actually in a strong position. Those of you who were in the room with me that day will remember the level at 25,660. Above that level, we were only looking for long trades. Price tested 660, firmed up quickly, and continued higher. The market was telling us exactly what it wanted to do. Interestingly, the indicator performed just fine on its long signals that day, but the short signals failed. And that wasn't because the indicator was broken, it was because the market was strong. In a strong market, we look for long trades only. Taking short trades in that environment is not trading opportunity, it's fighting market intent, and most of the time, that fight ends in a loss. At this point, I want to be very clear about something. I'm not saying that short trades can't work in a strong market. They can, and I'm not saying that every long trade in a strong market will be profitable. That's not true either. What I am saying is this: in a strong market, long setups carry a higher probability of success than shorting that same market. And the opposite is true in a weak market. Trying to buy weakness has a lower probability of success than trading in the direction of that weakness. Trading isn't about certainty, it's about probability. So our job as traders is always the same: identify what the market wants based on its condition and align ourselves with that intent. In the live room, every morning before the session opens, I go over the key levels the ES and NQ are watching. We map out potential targets, outline both bullish and bearish scenarios, and clearly define where the market is stronger and where it becomes weaker based on specific prices and levels. For example, on Friday we identified that NQ was weaker below 750, with downside targets at 660 and 610, and stronger above 750, targeting 830, and potentially as high as 950. Price quickly broke below 750, traded down towards 610, and made a low at 615, just shy of our target. From there, the market turned higher, reclaimed 750, firmed above it, and then proceeded to reach both the 830 and 950 upside targets. That trader ended up joining our community and started attending the live trading room, where every morning we went over the key levels, targets, and market conditions. This time, instead of trading his indicator in isolation, he used it in confluence with what the market was actually doing and attempting to do. Over the next 2 trading days, that shift made a meaningful difference. He generated over $900 per account across 5 TPT accounts. Overall, during that period, he took 6 trades with only 1 losing trade. And it's important to point this out. The indicator didn't change. It was the same indicator. The only difference was that he became selective about which signals to take. When those signals aligned with market intent, the probability of success increased dramatically. But this isn't about finding the perfect indicator, because if anything, this one was very simple. It's about trading in the direction of the market by understanding what the market wants. As most of you know, over the years I've been exposed to and have shared dozens of different indicators. And one of the questions I get asked all the time is, which one is the best? I don't know if I can answer that, because I don't believe there is such a thing as the best indicator. What I can say without hesitation is this: no indicator by itself is going to make you profitable over the long term. Indicators are tools. They're meant to be used as part of a structured, reliable trading plan, not followed as random signals. When an indicator is aligned with market condition and intent, it can help with execution. Without that context, it's just noise. Trading indicator signals without understanding the bigger market picture is like aiming perfectly at the wrong target. So the takeaway here isn't that this trader found a better indicator. He didn't. The indicator stayed exactly the same. What changed was his understanding of market condition. Once he stopped trading signals in isolation and started aligning them with what the market was actually doing, the probability shifted in his favor. Strong market, he focused on longs. Weak market, he focused on shorts. That's not prediction, that's alignment. And when you consistently trade in the direction of market intent, trading stops feeling random and starts feeling structured. That's what we focus on in the live room every morning. Understanding what the market wants before we ever talk about entries. Thanks for watching. If this helped you in any way, feel free to leave a like. You're always welcome to join us in Discord, and I'll see you in the next video.